Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy.
Right, I'm going to start on the first slide with the dollar index today. So, wait for the chart. Here we go. On the dollar index, looking at this, so it's the same lines we look at on the monthly chart. We always put the Bollinger Bands on. We've got that pink line in the middle, which is the 20 moving average. And we can see that price managed to rally above that line and get up to the sort of 50% area. Then price has fallen back down to that 20 period moving average, which is at 104.97 at the moment. So this is a key area for the dollar as it moves back down here. It broke above the moving average, and then it's come back down after failing at that 50% of the 2022 collapse. So now what we need to do is use that moving average as a pivot this month. While price can hold above that area, there is another push higher. Dollar strength can't be ruled out. But if price moves back below and holds below that 20 period moving average, then we're on for a move lower and a bit of dollar weakness. And you look for a stronger support in the 102, 102.30 area, maybe 103. Resistance on rally should be in the 106.30, 80 area, which is where I sort of think we might be capped initially. If we can get above there, you could see a run up towards this 107.50, 80 area, but that would be a lot of move back into the dollar and sort of forgetting the end of last week. But I think what will be important at the moment, is just watching that 105, 105.40 as a pivot. Now, there's a lot of risks for myself coming here. And one thing I spoke about last time I did the webinar was in September. And I said that what really is my fear, it's not so much central banks and economists' excitement each month about interest rates. Have they peaked? Are they going down? That's on everyone's radar. Everyone's all over that. That doesn't really interest me. But what I said in September is something that blindsides, something that the market's not ready for, blindsides you. And I said my worries were over the China-Taiwan tensions, if they start to grow, and other tensions that weren't on our radar. And now we've had something hit that wasn't on our radar. Tensions have hit in the Middle East. And I think we're going to see more tensions as this year goes on. And I think there's risk for oil and trouble in equity markets potentially. So, I could see markets rally a bit, but then stalling mid-month and a lot of volatility just before you get to the Thanksgiving time, the last, that 25th week the week of the 23rd, 25th in November. And I think a lot of people won't want to be wrongly positioned going into that weekend. So I think moves you see in the first part of this month, you might see moves happen, but then I think they sort of fall back ahead of Thanksgiving. And I think that's the risk here. So that's how I'm sort of seeing dollar index. Keep those levels in mind. And if we move on to euro dollar now. So here, euro dollar, in September, we re-looked at these slides, the same sort of slide where that big black arrow is. That was the retest of the trend line. Price fell off that trend line. And we said there that risk reward was changing. We saw the move down. And if we go to the next slide, I zoom in on this last bit of price action just to make it clearer. So in September, I said price was heading towards the 20 period moving average, lower down. And as price neared the 105.95, 106.30 area, maybe we could see risk reward start to change. And we've seen price get to that 38.2%. We've seen it get to that 20 period moving average. And what happened? The move down has stalled and we've seen a rally back up so far this month. So we've got the rally, but it hasn't confirmed. We haven't had a monthly close way back above that line. The month is very young yet. So the resistance to watch at the moment in euro dollar for myself is the 107.65.70, maybe actually 107.65, say 107.90 area. And price needs to break above that to be a good true break off this moving average. But we can use that moving average just as a pivot during the month. So we know while we're above that 105.74, maybe we're going to get a move higher. But if we see price start to move down below that, then maybe it was just a false move at the end of last week. Maybe other events are going to come back in and push things back. But I think at the moment, I think we get a relief rally here higher, and then price falls back later in the month, as I was saying, towards that Thanksgiving time. I think people won't want to be over that long period wrongly positioned. So initial support should be around 106.75, stronger support 105.60, 106.20. Any push back below 105.60, well, let's say any close below 105.50 on a daily close, maybe actually this rally is starting to falter and we aren't going to get that rally. But it's an important month to be looking at the daily and weekly charts that I send out. So make sure you're on the list, because these changes will happen quite rapidly. It's a fast-moving market at the moment. So I think if we go now to Sterling Index. So Sterling Index, the first slide here we're going to look at is the big picture. And this shows where the lines come from when we zoom in. So it's the collapse of sterling from 2015 to 2016. And we've looked at this chart ever since that collapse. And the one thing we've always gone on about, you never got a quarterly close back above the 38.2% retracement. But we got that quarterly close mid this year. We did see a quarterly close above that 38.2% retracement of that collapse. So that was a positive signal for sterling, that it managed to close up there. Now, if we go to the next chart, we're going to zoom in on the monthly chart here and look here at what's happened. So we got that move right up to the 50%, which is at 67.02. And it was the top of the Bollinger Bands. And you can see price fell back down. But where did it stall? It found support perfectly at the 38.2%. And that's held it for the last 2 months. The lows in the lows in sterling on the index have been exactly that 38.2%. So while that holds, there's, a chance that sterling picks back up. But it was a very negative month a couple of months ago. So we had to sort of get some confirmation that the market's forgotten that negative feel from the month a couple of months ago. But I think at the moment, one thing I said in September, as long as pullbacks were held by the support in the 61, 63 area, then there's still potential for this sterling to strengthen and go higher. But I think we can try and watch that a bit closer now and look at that 64.08 area. If you've got a monthly close below there, then that would be a concern now. Why has it gone back below the 20-period moving average on the Bollinger Bands? People have changed their mind on sterling. And we need to keep an eye on the quarterly chart and check where that is on the 38.2%. So to get positive, we need to take that negative candle from two months ago, get above that 50%, and that will open up to 61.8%. And the support, 64 from that mid-Bollinger, and also that 38.2% on the chart. If it breaks below that, then something's changing on sterling, and we need to change our view because price is changing. So the next slide is sterling dollar. So sterling dollar, this is the chart I had last time I spoke in September, and it's the long-term quarterly chart on cable. So if you look on the right, you'll see I've zoomed into the last bit of price action. You have a bearish outside quarter, a higher high, lower low, lower close. So that was after 3 months of the market, 3/4 of the market rallying. Suddenly the sellers took over. It couldn't break above that. At the time, it was 128. Now it's 127.76, the moving average. And I warned that the risk was, while you're below that 128, for a move lower. And we got that move lower. Now, there's a key area in the 120 area, which is the 38.2%. So on here, I've just got 120.75, but I might look at the whole 120 area. So I think for going towards the end of the year, what you should be looking at is, where is sterling dollar in relation to 120 and 127, 128? The resistance is going to be 127, 128. The support is going to be 120, 121. If any of those two sort of break, then that's a warning. Something bigger picture might be happening. But if we go to the next slide, we can zoom in just on the monthly chart. So on the monthly chart here, it was all very orderly. We saw price fall down, rally back up. It went back up. It failed at the top of the Ichimoku cloud, that yellow cloud. You can see the spike in July, went to the top of that, sell zone, fell off. Now, what's happened since the fall off there is interesting. And I've zoomed in on the next slide just to make it even clearer. So here's the fall. You can see it clearer there where it says 0%. That's falling off the top of the Ichimoku cloud. It swaps as support to resistance. So below its resistance. Where have we gone? We've simply gone to the 38.2%. And look at that area. It's 120.60. So on different settings, it's very annoying. Different charts have different highs and lows slightly. So I'm giving it the whole 120 area just to be safe. Because some say it's 120.75, some say it's 120.60. But it's that sort of area. And the key thing is for 3 months, it held as support and we're rallying up. Now, this is important. We closed for the last 2 months below the pink 20-period moving average. This month, we've had a rally up, but it's only gone to that 23.6%, 124.74 area. So watch those two. There's a good indicator in the first place. The 120.60, the 124.74. If you start to see a break outside those, it tells you who's in control of the market. It's going to be a very strange time. You know, we're going to the end of the year. Some people will be having to close positions. Some people will be wanting new positions. There's outside risks spoke about earlier. So a lot could happen here. And another thing to keep an eye on is as the month goes, use that 20-period moving average as a pivot. It's there. Look, the last 2 months, it closed below. Is it going to break above? You know, that's positive for sterling dollar if it can break above. If it can't hold above there, and you see that 120, 122 area break as support, then that's very negative for sterling dollar. So there's no sort of crystal ball here. You've just got to watch the levels and be ready for the break. It's going to be a tricky end of year, I think. Remember my comments on the dollar index. A lot of risks this year as we head into the end of the year. You've got to watch these markets closely. You've got to remember that they're not door numbers that don't change. They're markets. They move all the time. So it's better to be active rather than, you know, just react when you see something's happened. Know where the levels are. Know where things change is the key here. Know where the buyers and sellers are always based. And be ready if they break one of those levels. That is important. Now, the next slide is Euro Sterling. So Euro Sterling's on there in case you look at this Euro Sterling wise. But I know a lot of clients don't look at this Euro Sterling wise. Neil always tells me people on the webinar prefer it sterling euro. So we go to the next slide, that's sterling euro. But when the slides get sent out, if you want Euro Sterling, that will be there with the commentary. So back in September, price was below the 20-period moving average from the Bollinger Bands. And I said September's support was initially around the 116 area with 115.20 below that. And only a monthly close below 114.60 would be worthy of note. Well, price in September closed around 115.40, so it held that 115.20 area. It's now below the Bollinger Bands. Sorry, I meant to say it was above the Bollinger Bands earlier on, but it's now below the the 20-period moving average. So it's now below the 20-period moving average, but it hasn't managed a monthly close below 114.60. So keep an eye. It's quite an important time because with price back below that 20-period moving average, there is a risk here that it starts just to slip away. It is the sort of 50% of that very positive green candle. If you count back 1, 2, 3, 4, 5, 6 candles, very positive move. So that's why there's some buying interest here. It's called a Marubozu point. 50% of a very strong move is where people normally tend to come in and really try and do buy or sell. So I think this month, the easiest way to say, look for initial support initially around 114.60, 115.10 area, and then stronger support in the 113.60, 113.80 area. Resistance should be on rallies in the 116, 115 area, but stronger resistance is in the 116.75, 117.25 if price gets that high. But one thing we can do, we know where the 20-period moving average is, use that 115.60, 65 as a pivot from the 20-period moving average. And now we'll go to the most important slide, next slide, which is the disclaimer. And so that's really my thoughts. I've tried to condense them all down. If you have any questions, always talk to your salesperson. We can do a call together or send in an email. But I hope that helps, and I'll pass you over to Neil for some wise words now. Thank you.
Thank you, Piers. And thanks again for what's always an interesting update. And I think it's more interesting because we definitely missed you whilst you've been away. So we're glad to have you back. And in terms of my slides, we're going to go relatively rapidly through these. I think ultimately, quite a lot of these you'll have seen before. But in terms of the politics of 2024, I did a slide just sort of saying, well, when might the timing of the elections be the last time? I think this time I'm going to focus more on what might be coming ahead of those elections, particularly with a focus on the UK. But we move on to the first of the slides, and I just wanted to focus on a few things that I've identified. We are definitely starting to see a deterioration, as this right-hand chart demonstrates, in unemployment rates. So unemployment rates are starting to rise. UK, US, and the Euroland unemployment rates all rose in the latest periods of calculation. And on the left-hand side, this is US mortgage applications, which are now at a 28-year low. Just to put that into context, mortgage applications have been falling whilst mortgage costs have been, interest costs rose to around about 8% at one point in October, which has created this additional fall in mortgage applications. And if you think all the way back to the mid 1990s, which is effectively when we were last at these levels, and this is well before all of the explosion of borrowing that we saw in the 2000s that led to the financial crisis. But what we're seeing now is mortgage applications at a level lower than post that financial crisis. So the very fabric of major economies appears to be unraveling. That could have a very negative impact on economic activity for future quarters, which makes us want to look more ahead rather than look at data that's previously been released as far as GDP is concerned, because the GDP news is not fully taking into account the rise that we've seen in those borrowing costs that will have a negative impact on future quarters. So I wanted to highlight that economic conditions appear to be worsening, but there may well be worse to come as far as those economic conditions are concerned. And if we move on to the next slide and we look at what the response is of central banks, well, the central bank response has been to hold interest rates. But behind that decision to hold interest rates is a softening of the language that we've seen from all of those major central banks. So the Federal Reserve is now talking in terms of when might be suitable to start cutting interest rates. The European Central Bank is talking about when might be the most the European Central Bank is talking about when might be the most sensible time to be cutting interest rates, probably more or certainly earlier as far as cutting interest rates is concerned than we might see from the likes of the Federal Reserve, and potentially earlier than the Bank of England as well. And I wanted to draw your attention to the comments from Hugh Pill recently, which he said now is not the time to be cutting interest rates, but or talking about cutting interest rates. But the emphasis was very much on now. maybe in a few months' time, when we've got that inflation rates continue to fall back, that might be the time for central bank, particularly the Bank of England, to discuss when it might be appropriate to start cutting interest rates. We think into the second half of 2024, but that could be brought forward if economic conditions continue to worsen. So the on-hold decisions were not the be-all and end-all. The on-hold decision, in my view, was only part of the puzzle. We definitely seem to be seeing more language from central banks now that suggests that we're at the peak, although perhaps they're not prepared to declare victory in the fight against inflation just yet. So if we move on to the next slide. And I wanted to highlight this because retail sales activity is really, I think, a key battleground, and where the higher interest rates and higher inflation is likely to manifest itself most notably. What we've seen is retail sales values in the US continuing to hold up, but the squeeze on incomes is definitely hurting, and it's hurting more so where we're seeing retail sales volumes falling in the likes of the UK and Euroland. And there's been a worsening in labour market conditions, which I think will put additional pressure on retail sales, particularly if we're talking about discretionary retail sales. So just watch out for that, because I think there's some real downside risks here for consumer discretionary spending. And when we ask about what sectors are likely to perform worst, it may be those that have seen some of the largest price increases, where people have got a decision to make whether they want to make those discretionary purchases. So we could see that in household goods. We could see that in major ticket items. Things like auto sales, I think we should keep a close eye on in terms of whether or not they continue to hold up, or whether we see a further pullback in car sales. And there has been some signs recently that car sales are starting to decline once again, having seen a recovery, but they're still nowhere near where they were pre the pandemic. So retail sales overall, I think, is a very key indicator that we'll keep a close eye on in the months and quarters to come. We move on to the next slide, and I already mentioned that what we now need to focus on is not the timing or the potential outcome of the election in the UK or indeed the US, but what we might see from politicians in the run-up to these elections. So at the end of this month, Jeremy Hunt will update us on the public finances, and there's headroom for tax cuts, for spending increases, potentially for them to announce something on infrastructure spending or investment in the charge towards net zero. There are plenty of things that the government can do, but ultimately I think that they may well focus their attention on a few tax cuts and a few headline spending increases that they think will get them the most traction and headlines, positive headlines, for the upcoming election, which I still think is going to be in the autumn of 2024. So don't think that there's going to be big tax cuts as far as corporates are concerned. Don't think that there will be big tax cuts as far as income tax is concerned. I think there will be some inflationary uplift for the income tax thresholds, or some direct cut to the basic rate of income tax, or something along those lines. I don't necessarily believe that it will be a full inflationary uplift. I mean, they have actually announced, the government have actually announced they won't uprate the income tax thresholds for several years, but I think they may back away from that in order to try and generate some economic momentum heading into the elections in late 2024. So just watch out for pre-announcements ahead of the UK budget. We tend to see quite a lot of interest in what the government pre-announced that will go in all of the major newspapers. But ultimately, I think that those looking for big tax cuts or big spending increases are going to be disappointed. I don't think that they will necessarily yet feel that they have the fiscal firepower to deliver on those, and that it will be more limited, more targeted spending increases and tax cuts that I think they will move forward with. And if we look at the final slide of mine, well, I think what we can see in terms of the development of our forecast is that clearly the weight of dollar strength and the pressure that we've seen on sterling and the euro recently has taken its toll on our forecast for the short term. So next sort of 6-7 months, we've significantly downgraded our expectations for sterling and the euro, but we still see a productive period for sterling and the euro against the US dollar in the second half of 2024. Now, that may well coincide with lower interest rates in the US, but remember, interest rates in the US will have to move materially lower versus expectations and materially lower relative to what we see from the UK and Euroland. If we don't see that, then I think there is a room for disappointment in terms of a dollar sell-off. I think that is the risk to these forecasts, that we might not see the scale of dollar sell-off that is captured by these current forecasts. But certainly heading into the end of this year and into the first quarter of 2024, we're quite downbeat on the prospects for sterling and the euro against the US dollar. So just watch out for that. Watch out as well to see whether or not we get direct intervention from the Japanese authorities or the Chinese authorities to try and take the weakness out of their currencies against the US dollar that we've seen of late. So we might still see that. I think realistically, we're heading into a period of range trading going into the end of this year and the early stages of 2024, and it'll be interesting to see which side of the ranges we break out of in sort of second, third week of January. I think that could be a crucial point in terms of determining the direction of travel for sterling, the euro, the yen, and the Chinese renminbi against the US dollar into 2024 and beyond. Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.